Good evening and welcome to the Institute of Real Estate Education's live exam study session. Tonight, we're going to be working with exam type questions. I'm Rick Roller, and I'll be your game show host for this for this evening. Also with us is Mr. Dan Naylor, our owner, operator, head bottle washer. He does everything for the company because he owns it, okay? And he's doing all the technical work tonight. And we're thrilled to be here. And I'm glad you're here, whether you're watching it live tonight or whether it's on the webinar on demand type program with the school, because we're going to be discussing finance type questions. And these questions will bear a striking resemblance to things you may see someday when you're trying to get a license. Okay, so pay attention because I'm going to give you the answers. Let's start off with number one. Mainly, we're dealing with finance questions tonight. Okay, so this number one talks about subordination. And what is a subordination clause? So we're going to screen share. Oh, here it is. A subordination clause in a loan would involve which of the following actions? Now, if you're an employer and you have employees, sometimes you call those employees subordinates. You know, they work for you, right? So when you're talking about like a submarine, a subordination clause is a clause that changes priority. Priority meaning, are you first in line, second in line, or third in line? So a subordination clause in a loan would involve which one of the following actions? Would it involve A, assignment to a new borrower? No. How about B, alteration of priority? Okay, it was here a higher priority, a number one priority maybe, and there's a subordination clause. So at some time in this loan's life, it could become a number two or subordinate to a new loan that came along later. An alteration of priority, ooh, that sounds warm and fuzzy because it's the right answer. An abandonment by the borrower. No, that's being a flake and walking away from your loan, and then it's going to end up foreclosure. Or abrogation. An abrogation clause is a clause that says it's over with, it's done, it's dead. So of all these guys, of course, it has to be the number B, which is an alteration of priority. If you have a subordination clause loan, a very common use of this is where you're buying a lot and you're a builder perhaps, or you're going to be working with the builder to build your new dream home. And let's pay, the lot's $150,000. So you pay 75 grand down. Okay. So you have $75,000 on that lot loan. But when you go to get your construction loan from a construction lender, they're going to want to be in first position, not second position, because the lot loan is already there. So it's in first position. First to record is first and right, unless that first to record, that lot loan has a subordination clause, which allows that loan to be changed in its priority. So the bank won't give you the construction loan unless they're number one, they're in first position. So in order to make that accomplished, it has subordination clause. Now, we're not going to rely on a subordination clause if we're a construction lender. We're going to say, okay, that's great. Whoever has that lot loan has agreed to come after us, but they're going to release the lot loan, record the construction loan, and then put the lot loan back on, because they want it to be extremely clear that where the priorities lie. So correct answer to this one, of course, is a letter B. Let's look at number two, please.
Hey, hope you're enjoying the video. Be sure to like and subscribe so you don't miss any more of them. And if you want even more review material, we have in the PrepMyExam link in the comments. We've got a plethora of practice exams. We have audiobooks. We have an exam simulator. We have everything that our students use to pass the exam on their first try. Okay? And if you want to get licensed in Utah, check out realestateonlinelearning.com and we'll hook you up.
Now we're talking about loan to value ratio. Loan to value ratio means is this 100% loan, an 80% loan, and whatnot? Well, because the loan is the 80%, the total value is 100%. Lenders like low loan to value ratios because it gives them more security. If you have a 100% loan to value ratio, it means that the buyer on that lot doesn't have a lot of holes, it doesn't have any skin in the game except for his credit. And he might walk away. Banks don't like that. So they would rather you had, a decent amount of down payment. Traditionally, what is that down payment that makes them warm and fuzzy and comfortable and able to sleep at night? You know, well, it's 80%. So this question says if a loan to value ratio is too high, the lender will want mortgage insurance because he wants someone else to shuck that that risk that you might default on the loan to someone else. And so, there's an insurance premium that's paid, and there's someone that steps up and says, I've done all the math and I have an actuary that's figured all this out. And so we know that if we collect this much money and we have this many defaults, historically and whatnot, that, we're going to make good money here. And so the lender will want mortgage insurance to protect its interest in case of default and foreclosure sale. In most cases, what is the number that triggers the mortgage insurance being paid? Well, if they're warm and fuzzy at 80%, it would be C, 81. Anything over 80%, they're going to want mortgage insurance. Well, it's just 1% over. Well, then come up with another 1% down so you don't have to pay the mortgage insurance. But 95, 90, and 81, you're going to have to pay the mortgage insurance. What about D? Would you have to pay mortgage insurance there? Of course not, because it's less than their comfort level, which is 80%. So they're going to feel real comfortable with that, particularly if you have great credit. Number 3, please. Looking at number 3, it says, in order to obtain underwriting approval for a federal Fannie Mae loan with the loan to value ratio of 90%, what must the applicant have? Well, from that last discussion we just had on question 2, we know that the lender will lend you some money if it's over 80%, but they want someone else there to help mitigate that risk. And that someone else is going to want a premium, for the insurance to mitigate that risk. And but that's okay, because sometimes people need the high ratioed loans in order to get into the home. But in order to obtain underwriting approval for a federal Fannie Mae loan with a loan to value ratio greater than 90%, what must the application have? What do you think? Well, just what we were talking about, primary mortgage insurance. Mortgage insurance that says that if that primary loan goes into default, someone else will be there to share the risk, which lenders like. They don't want the whole risk. Well, who do you think is going to pay a premium to get that primary mortgage insurance? Well, the borrower does. Well, the borrower says, well, I don't want to pay that. Well, then fine. Come in with 20% down. Then we're all happy. Well, I don't have 20%. Well, then we're going to want some primary mortgage insurance. Business interruption insurance, flood insurance, homeowners insurance. Yeah, but that has nothing to do with underwriting approval for a federal Fannie Mae loan with a loan to value ratio of 90%. Okay, what we're really talking about here is primary mortgage insurance is the correct answer, and that is A. Okay, these are great concepts, folks. You're going to see them again sometime when you're sweating there in front of a computer trying to get a high enough score to go out and get yourself a real estate license. Let's look at number 4. So pay attention to these. Number 4 says, which of the following is a trigger term, as stated in a truth in lending pamphlet given to a potential borrower? Most agents don't do this, but I would strongly recommend that you read that pamphlet. Lenders have cases and cases of them because they have to give them out, to all borrowers. And so, drop by your local lender and say, I want to have everything you give to a new borrower because I want to read them and I want to understand them and be familiar with it. There is a difference between a prepared, educated, and helpful agent and one that just sits there eating a cookie at the closing because you don't know what's going on, and they'll know that. If you want referrals, you want to demonstrate your proficiency. So what is a trigger term? Okay, well, out of all these, there's a federal law that says if you say this, you have to say other things. Okay, well, APR could be in an ad all by itself. The fact that it's a loan could be all by itself. The price could be in a ad and all by itself. Okay, but what you cannot advertise because of federal rules, if you say one of these, you have to say everything else. Okay, and the main question on this is the concept that APR can be advertised alone without any other thing. And so you could have an ad that says, hey, come in and buy this great house, 8% APR. Okay. But if you say a payment or anything else, that's a trigger term, which says if you say payment of 800,000 or $8,000 or $800, whatever it is a month, then that is a trigger. And so if you tell that, you have to say everything else. So APR can be advertised alone. The fact that, get an $80,000 loan and the price of the property obviously can be advertised by themselves as well. Okay, so A is the correct answer there. Hey, we lost that, Dan, before you highlighted it. Okay. So number 4, the correct answer was A. Okay. Payment. Thank you. Let's go to number 5, please. Number 5 says, which of the following statements is true of both truth in lending and RESPA regulations? In other words, there's an overlapping between those two federal laws to where both of them kind of, say, well, you better do this. Okay. Well, let's look at our potential answers. APR must be used in advertising. Do you have to advertise with the APR? No, that's B. Now I skipped A because it's the right answer. So I'm highlighting the wrong answers. The booklet settlement costs and you must be given, but that's not in both RESPA and Truth in Lending. It's just one or the other. Okay. And then the other one, they can cover loans to small businesses. Really, when we're talking about Truth in Lending and RESPA loans, we're not talking about commercial loans. We're talking about loans for single family residences. So A is the correct answer. They cover single to 4 family dwellings. Yes, if you can get a duplex, you can get a triplex, and you can get a fourplex. One of my buyers I worked with many years ago had a VA loan he never used, and he was renting. And I said, we ought to get you into some investment properties. This was a highly paid federal employee. He wasn't married, didn't have kids, didn't have many deductions. He was paying a grundle in taxes. And one December, when he was working with his accountant and getting ready to figure out what his tax bill would be after the first of the year, the the accountant, I said lender, but the accountant said to him, "Look, you need to get some write-offs." I mean, this is crazy. You're paying way too much taxes. Well, what should I get? He says, well, you need to buy some investment real estate. Well, I came to in his life like 2 days after that. It's nice to have accountants that'll tip you off. Okay. So anyway, man, so immediately I sold him a fourplex. He had a VA. He bought the fourplex on a VA. Okay. And then he bought a duplex, and he bought another lot, and then he bought a single family, and all within about 4 months. So that was great. I hope that happens to you too. But anyway, when the following statements are true of both Truth in Lending and RESPA, A, they cover single to 4 family dwellings. These are consumer protection type laws. So if you're going there and buying a 24-unit apartment building, you're supposed to be, a sophisticated investor that doesn't get the protection from Truth in Lending and RESPA. Number 6. Number 6 says, which of the following entities is only in the secondary mortgage market and not in both primary and secondary? Primary lenders are lenders you go sit down with and apply and actually get the loan. And then secondary lenders are lendings that the primary lenders sell their loans to. Primary lenders, the whole idea is to churn a lot of loans through and make fees on the loans. They don't rely on keeping the loans and benefiting out of the interest and the mortgage payments that come on a monthly basis. That's the secondary guys. That's their business. The secondary guys buy the newly originated loans from the primary lenders. And a lot of times, the secondary and primary it's the same people, but a lot of times they're not. If you go to a mortgage company, they sell all their loans and they sell them to secondary lenders. If you go to a primary lender, like in our area, one of the largest ones is Security National Mortgage. They lend their own money in many, many cases. And so if that's the case, well, they're both primary. They are the primary, but they do buy other loans too. There's secondaries as well. So which of the entities below are only in the secondary money market? Well, would it be Ginnie Mae, Government National Mortgage Association. How about banks? Banks do both. How about insurance companies? Insurance companies do both. Insurance companies, insurance companies love to do small commercial loans. Like the little office building you want to build for $2 million, and you want to finance 80% of that. They like that. Private individuals, well, that's not what we're looking for here. Guys, the correct answer is A, Ginnie Mae, Government National Mortgage Association. Ginnie Mae steps in and takes over these loans. They get packaged up into larger packages, and the whole package is sold to either Fannie or Ginnie. But both of those are secondary money market lenders. Number 7, please. For you veterans out there talking about VA loans, the VA lends money and the lender guarantees it. Guarantees the loan? Don't think so, guys. Okay. How about the lender provides money and the VA insures the loan? How about the lender provides the money and the VA guarantees the loan? Or D, the VA provides money wholesale to the lender and the lender makes the loan. Okay, now of all these, the big thing about being a veteran, and thank you for your service, the thank you goes on even after you come back because you have VA benefits. And one of the VA benefits is you can get very favorable loans. And the lending requirements to obtain those loans are softened a little bit. So if you applied for a conventional loan and you're a veteran, and they say, well, you're just a little shy of making this work with your income, but you go apply for a VA, they very well might approve it because their underwriting standards are a little bit more liberal as a thank you for the service. I mean, if we didn't have our military, we wouldn't have a country, and so there are benefits, and you should take advantage of those benefits. That gentleman I talked to earlier, that you can even buy a fourplex with a VA loan. So he was living in a rented apartment. I said, we need to get you a fourplex. I mean, and after he bought the fourplex, even though he put extremely little money down, they wanted a tiny bit, but not a lot. The fourplex cash flowed. In other words, he lived free after that because the other 3 units made enough money, enough cash flow, and to pay his expenses and the loan expenses. And so, he was paying apartment rent before, and then after he bought his own fourplex, he had a free ride. Look for opportunities of individual potential buyers who have VAs and never use them, excuse me. There are some requirements. Owner occupancy is one of them, and there's a few others as well. But all your lenders understand these, or if they don't, get a lender that does. Number 8, please. Oh, wait a minute. Let's highlight. Yeah, that's it. See, the lender provides the money and the VA guarantees the loan. Now, FHA insures a loan, and there's insurance premium that's paid. But because you're a veteran and you served our country and protected the rest of us, you get VA guarantees. Now, there is a little, small charge, but it's not like a normal private mortgage insurance or even government loan insurance. Let's look at number 8, please. Number 8, L agrees to carry a second in the sale of the home. It was for 20 grand, 9% interest, 30-year payment of $160.92 per month. However, it had a 5-year call. Now, a call is after the 60th payment, or during the 60th payment, you have to pay that loan off. So even though it was amortized over 30 years, there was a 5-year call, which means you're only getting a 60-month loan. But hey, that's still 5 years. So you could either refinance or sell the property or pay it off. So anyway, the call, when the lender would pay off the balance of when the buyer, also the borrower, buyer-borrower, would pay off the balance of $19,176. How would you describe this loan arrangement? Well, there's a call, meaning there's a balloon. Anytime you have a payment in a loan that is in excess of the normal periodic payments, okay? The normal periodic payment was $160.92 per month, okay? Well, there's one whopping payment coming up that's going to be $19,176. I mean, obviously that's an excess of the 160 and change. So that means it's anytime you have a payment that is larger than the normal periodic payments, which we definitely have here, it's not fully amortized. It's fully amortized means that, over the 30 years it pays the loan off. This one had a call. So, and there was a balloon of 19,176. It's not a wrap. A wrap is a loan that your collateral is more than one property, or usually the more common use of a wrap is where you have an existing loan on the property you're buying, and the seller, says, hey, well, why don't I carry that? I got a 3.5% loan. This guy's willing to pay 6. So why don't I wrap that 3.5 and carry not only the amount left on the 3.5, but the additional monies over that it would take to fully fund the financing that the borrower is trying to get for the loan. So, hey, the advantage to the seller is that he not only makes out of his equity in that loan, which means the money that he has as his equity is over the loan amount. You have a purchase price. Usually borrowers put down a little bit of down payment, sometimes bigger, sometimes littler. But anyway, there's a down payment. And then there's a loan to be financed. So what happens in a wrap is you take that figure to be financed, and that includes the existing loan. But maybe the interest rate 6 that you charge, which for the sellers is a cool thing, because he's, in essence, he's borrowing the money at a little less than that and then renting it out at a little bit higher, Well, this in the case, it's 9, which is pretty high anyway. But it's not a discount, and it's not partially amortized. Okay, partially amortized would mean it would have to have a balloon. So on number 8, what we're looking for is partially amortized because of what? Is there a balloon in this? Ah, very good. You caught it. Interest rates, 30 years, payments 160. However, it's a 5-year call, which means it's all due and payable in 5 years or 60 months. And that would be only partially amortized. Fully amortized, A, would mean that it would have paid out over the loan term, which in this loan, because it had a 5-year call, would be 60 months. That's going to be some pretty high payments. Not a discounted loan. It's not a wraparound. Wraparound covers more than one property loan. Or no, I'm sorry. A wraparound covers an old existing loan, generally because there's an interest rate push that the seller can take advantage of between the 3.5 and the 6 he's getting from his borrower. And fully amortized means it has equal periodic payments over the entire life of the loan. Well, this one has 30-year am, but it's not fully amortized because there's a 5-year call. Okay. And, it's common. A lot of you see this a lot, maybe in not a lot in institutional financing. Maybe if you've got a really good in at the credit union or something, they might do something like this with you. But primarily, this is going to be an owner carry type thing. Okay, let's look at number 9. Now, number 9 says E borrowed money. Okay, that makes sense, from a bank for personal reasons. It had a fixed interest rate for a 5-year term. Monthly payments were interest only, and at the end, E owed the lender the full amount borrowed. What kind of loan is this? Is it a purchase money loan? Well, no. Why? Well, look at that first sentence in there. It's for personal reasons. Purchase money loans are used to buy the property. In this case, clearly he already had the property, already has a fixed rate interest loan, although it's just a 5-year term. But it's not a purchase money loan. Participation loan is kind of an oddball. You don't see them that often, but it's a loan where the bank says, well, we not only want, or the individual is carrying the loan, not only do we want the interest, but we want a piece of the equity when you sell the property as well. Well, for that, maybe you got a real low interest rate, or maybe you got a loan you couldn't qualify for, or maybe this is some sort of owner financing. I don't know. There are a lot of different ways where you might see a participation loan. Not real common, but you need to know what they are. A straight loan, well, that's normal. That's a loan where you get it and you make payments and you paid it off. But a partially amortized loan is a loan where you're making payments, and then, and like this one here, there's a call. But Partially amortized could mean more than that, okay? And so what we're looking at here is another word for this would be a straight loan. Okay? C. Okay. Some of these terms make perfect sense, like partially amortized, and some of these terms don't. You just got to know what a straight loan is. And what is a straight loan? Well, there are IO payments, and then there's a balloon. Let's look at number 10, please. Okay. Which of the following terms is not applicable to an adjustable rate loan? Well, an adjustable rate loan, there is a margin that is put into place, and that is the lender's profit. And see the not, does it, how it's capitalized? They're not trying to trick you here. But usually on adjustable rate loans, there is not a discount. Now discounts can be paid up front primarily, and it's so you get a little better interest rate. But on ARMs, the interest rate changes over the life of the loan depending on what's happening in the market. So the lender feels they've already got that covered. Index loan is a loan that would they use an index, some sort of financial index, and normally look back up at A, there's a margin that they put on top of that in index, and that's how they come up with your interest rate. And remember, it's an adjustable rate mortgage, which means that there's going to be an adjustment period. Normally they're annual. Sometimes they're a little shorter than that, but it means that every 12 months your payment's going to change. If the economy has demanded lower interest rates, your payment might go down. But normally what happens is interest rates may go up, and so the lender likes this kind of loan because it gives them a chance to re-amortize it and make more money. And a cap says, okay, it can't go any higher than this. So let's say you got that loan for 4.5%, cool, but it goes up in year 2, 3, and then it caps. But it can't keep going up forever and ever. So usually when you put a cap on these types of ARMs, it gives more comfort to the borrower knowing that, well, in the long term, I can afford a little increase in payment over the years because I have regular raises, and I've got my car about paid off, and I have all my consumer debt will be paid off in 3 months. So, they're planning ahead. They know that even though there's going to be an increase in payment, that, they can handle it because of, being smart financially. Number 11. Number 11 says, if R, hey, that could be me, R wanted to buy Q's home, but being new on the job, he couldn't get a loan. Now, lenders like you to be in the job for a while. There are some exceptions to that. I got a loan for a young nurse who was in college. She did her 4 years, and she got a master's degree after that in nursing, and but she'd only been on the job 6 months. But the underwriter said, you know what? She's been preparing for this job for 6 years, or 5.5, or whatever it was. So we're going to count that as longevity in the profession. So what happens is one of the things that happen is being new in a job could put you in a situation you couldn't qualify. But don't give up. Just because one underwriter said no doesn't mean that they all will. And ask around. Some underwriters are a little bit more liberal, and this one said, well, wait a minute. I know she's only been there 6 months, but good grief, she's been in school forever preparing. So I'm going to count her time in school as time at work. And loan sailed right through. So Q agreed that with 15 grand down, there was an existing loan on the property. Q would carry a loan for the remainder. Now, R wanted to buy Q's home. So who is Q? Q is the seller. But being new on the job, they couldn't get a loan. But the seller said, well, I'll tell you what, if you come in with a hefty down payment, like 15 grand, then I'll help you with the financing. In other ways here, they carried part of it. So Q would carry a loan for the remainder of the purchase price amortized over 30 years at 8%. Okay, so what is that? Which kind of loan is that? Well, if the loan that R is getting from Q, there is just one payment and one loan. In other words, Q wrapped the old loan. So out of this money that is in the new loan, part of it was the old loan that was Q's, okay, probably. And so, but it probably wasn't 8%. So Q's going to make 8% on his remainder of his equity. Plus, if that old loan was 4.5, he's going to make another, little push between the difference between the 4.5 and the 8. So, kind of a nice situation for them to be, for Q to be in. He's kind of like borrowing the money at a lower rate and lending it out at a higher rate. But what do we call this? Well, guys, it's a wrap, because you wrap the old loan. It's not a blanket loan. A blanket loan, like on a cold winter evening or fall evening coming soon, a blanket could cover more than one person, giving you extra comfort and heat. But a blanket loan is a loan that covers more than one property. Okay, a double contract? No, it's not a double contract. A double contract is a contract to buy, and it is illegal. A double contract is where you're trying to deceive a lender by having two written contracts. One at a higher amount that you're going to show the lender and try to get a higher loan, which is lying, or and that's why it's illegal. But you have a real contract that it's for a lower amount, and you're trying to get the lender to loan more money than they normally would want to, and you're lying about a lot of things. So you're going to lose your license over that if you were involved with that. And a discounted loan or note. Okay, well, a discounted loan or note is something that maybe a seller did seller financing, so he carried some money, but he really wanted cash. But he's willing to carry the financing for a while, but then he needed cash, and so he went to another lender and says, "Look, you do lots of this type of lending. Why don't you buy my loan?" And so he may sell it to him. He may sell it to him a little bit at a discount. So it may have been like a $200,000 loan, but on the principal amount. But maybe the second lender that came along says, "Well, your interest rate is a little shy of what I normally like to get in a rate of return on my invested money. So in order to get to that return I normally want, I will give you a lower amount. It was a $200,000 loan. I'll give you 185,000. So he's buying a $200,000 loan with $15,000 discount, which is going to increase his yield. So number 11, the correct answer is A, wraparound, because you're wrapping an old loan. Okay, let's look at the next question on our list of questions for more fun. Number 12. Now here's a seller that has trouble selling your property because they have a due on sale clause in their mortgage, and they don't want to have to pay off the balance. Well, due on sale clauses in mortgages say that if you sell that property, we're willing to make the loan to you, but we don't want someone else coming along and taking over your loan. So if you sell the property, you got to pay us off. It's called a due on sale clause. Very common. Otherwise, that buyer that came along may not be as financially strong as the first borrower, and so the bank doesn't like that idea. So they draft two contracts. The one to sell the property and another to show the lender. Now, didn't we just say that was illegal? Didn't we just say this is lying to somebody? Anytime you lie, it's going to get you in big, big trouble. So don't lie. Just, hey, find a lender that'll do the deal with the facts that are there. Or maybe you can't, so they can't buy, or they have to get an owner carry on the full financing or something. Okay, and show it to another lender so they don't know the property's been sold. Another lie, okay? And they invite an agent of the transaction broker for the sale. And okay, hey, we put this deal together. We're all happy with it. Would you come in and make sure the paperwork's okay, and we'll pay a little bit? You'll be a transaction broker. Yeah. Okay. Well, you're not going to do it, or your broker won't let you do it, because look at D. That's our correct answer. Advise the seller and the buyer. That's a double contract. It's illegal. That's the correct answer. Now look at A. Get errors and omissions insurance. Errors and omissions insurance doesn't cover cheating and lying or illegal acts. They're going to say, you got to be kidding me. Yeah, this got in default. Someone lost money. I mean, now you want us to come in and make it right? Forget about it. This thing was a lie from the get-go. B, choose either the buyer or the seller to represent, but not both. What does this have to do with representation? I mean, That's a throwaway answer. Hide the transaction from their broker. You knew that one was wrong. All right, cool. Let's go to the next one, please. You're having fun yet? Hope so. You know, you're going to see questions just like this. Not word for word, but the concepts are there. And getting these down is real important. And I suggest this is when you're preparing for when it's the last week or so and you're cramming for the exam, okay? Please, get a hold of these test questions and study the test questions, okay? Okay. Now, if you have questions, I know I'm pushing a little hard, and fast, but we have 2 in the chat right now that it got. If either of you people have any questions, just raise your hand with the software and we'll get them answered. Okay. So number 13 says S owes $500 to P for services rendered. Okay. Now P owes $450 to S from a previous transaction. Okay, so S owes $500 to P, but P owes $450 to S. Okay, all right. They decide to resolve the difference and just have S owe the $50 difference. Okay. Is this a lease? No. Is it a foreclosure? Oh heavens, no. They're getting together and paying off the loan. Is it insider trading? It does this sound like a stock thing? No. It's a set off. A set off says, okay, look, I owe you $450 and you owe me $500, so I'm going to set off $450 of the $5 you owe me. Just give me $50 and we'll call it done. It's a set off because there was another loan that was forgiven that was given credit to the total balance that was due. We call it a set off. Now, does that make any sense? May after you think about it for a while, but you need to know the term a set off. Well, now you know what it is. It's where someone says, well, you owe me, but I owe you. So why don't we just settle it for the difference? Okay. And that's called a set off. Okay. Cool. Number 14, please. At number 14, it says, what kind of insurance would provide the most protection for the buyer of the property? Protection. Protection from what? Well, from losses. And we're talking about not hazard insurance. We're talking about what? Title insurance. So different title insurance policies have different things that they cover. But the very best one that has the most coverage for different things would be better than the other ones. So plain language policies are great, but that's not what we're talking about. ALTAS stands for the American Land Title Association, and they have policies that are pretty standardized, so that would be standard policy. So if it's an ALTA policy, C and D are essentially the same thing. And plain language is, they're out there. But what we're really looking for on this loan is the extended owner's policy because they want more coverage, okay? We give the most protection. And there's just a couple different things it covers other than the others. And that's not a big deal for our purposes tonight, but you need help on these deals, okay? You need an excellent lender, right? You need a good inspector. You're not going to be able to pick the appraiser. The lender's going to do that, or actually a service does for the lender. But you need good insurance agents and you need good title companies. You need people that can help you. Oh, and a good inspector too. I didn't mention that. They're part of your team, okay? So sometimes these extended policies, they pay a little bit more for them, but it's necessary because it mitigates risk. And your title company will keep you in the loop on that one. All right, let's look at number 14. Oh, we just did it. It's extended policy. Yeah. Number 15, please. A purchase offer for a property is signed, and after the title search is revealed, there are 2 liens outstanding on the property. So what's true? Well, if there's 2 liens on the property and we're trying to get ready for the closing, and someone's going to step up and buy that property and pay all the money that they're asking, or all the money that they agreed to anyway. So what we're looking at here is this, the seller could have 3 loans. The seller could have 1 loan. But whatever loans are on that property, or judgments or other types of things that directly affect the property, the seller's got to pay them off. They've got to satisfy those liens. And of course, they're going to price the property accordingly so that they have enough money to do that and hopefully make a profit as well. So the correct answer to number 15 is A, but look at B. The buyer and seller will easily share in responsibility. Now, why would the buyer have to share in the seller's past financial dealings? No, I'm buying the house and I'm paying this price that we agreed on. Maybe it was full price, maybe it was a little bit negotiated. But the seller agreed to sell it for that price. And that means the seller's got to pay off all the liens and all the encumbrances and give it to the buyer. And, normally the buyer's going to get his own loan, and that lender doesn't want all that garbage on there either. They want to be in first position. So that's what happens. See, existing liens are eliminated when the property say, yeah, I'm going to sell a house and not pay anybody off and just keep all the money. I don't think so. The seller is solely responsible to satisfy those liens. Really, the money kind of comes from the buyer. But yeah, but the best answer, guys, is A. The seller is solely responsible. The buyer's not solely responsible. I mean, he paid the money to buy the house, but the seller is solely responsible. And that is enough on that. All right. Which of the following is not a true statement about the settlement statement? Okay. Settlement statement. Okay. A is to account for all the money involved in the transaction. Is this a negative question? Isn't that what the settlement statement does? It has all the financial arrangements. Sure. How about B? It will note if monies were paid up front. Yeah. Well, what are monies that are paid up front? Well, I mean, earnest money for one thing. Sometimes, particularly in commercial transactions that might take, 6, 8, 10 months to close or something. There's an initial money that's paid up front as earnest money. Sometimes that's released directly to the seller. Sometimes it's not. But if it's been released to the seller and, we're progressing down the road towards the closing, uh, the seller wants some more assurance that the buyer is really going to do the deal. And so, maybe they're going to have to ante up some more. But what the settlement statement will do is it will detail all this. Okay. So let's look real close. It will note if monies were paid up front, of course. We're looking for something that's not going to be on the statement. And that would be, in this particular case, C. The seller's loan payoff will be a debit to the seller and a credit to the buyer. And it's not going to be a credit to the buyer. Okay. Why would the seller's payoff be a credit to the buyer? Think about it. It's the seller's old obligation he had that he's been paying on as he's owned his property throughout the years. And that buyer's going to say, hey, pay off your old loan or, so that I can get my new loan. Okay. B, the buyer's total closing costs appear in the back and front of the statement. Okay. Well, that is true. Okay. But the one that's not true is the seller's loan payoff will be a debit to the seller and a credit to the buyer. It is a debit to the seller, but it's not a credit to the buyer. Okay. Well, unless the buyer is the bank, I don't know. That was off the charts. Don't pay attention. Okay. We have one more question tonight, and that is this one. We have a settlement statement, and the property is closing on March 16th of the year. The proration of property taxes would appear as what? Now, property taxes are something that's paid in arrears. In Utah, we pay our property taxes at the end of the year. Well, this is closing in March. So there are property taxes that have been accruing, but they haven't been paid yet. They won't be paid till the end of the year. Okay. So on the settlement statement, we've got to charge the seller, right? And then we've got to credit the buyer. A debit is a charge to whoever that is. If you debited the buyer, there'd be a charge to the buyer. So A isn't right. We don't debit the seller and the buyer. Look at B. This is the correct answer, by the way. We're going to debit the seller for his share of this year's taxes. And now, if this is closing in March, we've got a situation where the taxes may change. And usually we don't find out about this till around August or so. Now, one place where this is really an acute problem is when it's a new home. And the home was taxed not as a home, but it was taxed as a lot. And then the builder built a house on it. And now the buyer's coming in and buying the whole enchilada. But we don't know what the taxes are going to be. So sometimes we have to do a settlement of some kind, and then we have to do another settlement later in the year. And we call it a tax proration. But that's probably more than you wanted to know. What we want to know for this question is we're going to debit the seller, of course. Taxes are their responsibility, at least through March 16th. Usually the day of settlement is the seller's. Okay. And we're going to credit the buyer, meaning we're going to credit the buyer against what they're bringing in to buy the home, because they're not going to pay that into to the taxing authority until at the end of the year. So what'll happen is sometimes we'll estimate those, sometimes we'll do usually that's just a final settlement. The ones that are tricky is where it was a lot and then you built a house on it, and so you're prorating taxes on a lot, and then the buyer's going to get hit with taxes on the lot in the house, and so we have to pay attention to that and make sure it's fair for both parties. The buyer shouldn't, the seller shouldn't get out of paying the taxes through March 16th, and if it's for the whole house, well, then it's for the whole house. Okay. So something we deal with, particularly closings in, kind of like mid-year, like in March, like that. Hey, it is a great time to get into real estate. I don't care what you hear around. Oh, the market's horrible. The market's down or whatever. Hey, this is when the sellers need you. In a hot market where they, throw up a for sale by owner sign, and 4 people stopped and talked to them in 3 days that the sign's been up, and they're all excited about buying it. They still need you because there's a lot of peculiarities in a transaction that need to be attended to by someone that knows what they're doing. But they may not realize that. Well, we found our own buyer. We don't need you. Yeah, well, okay, don't get taken advantage of, because that could very easily happen. But in our market that we're in right now, where it's a little bit slower, that's okay, because now they really need you to help find them a buyer. Okay, and so buyer's market, seller's market, doesn't matter. It's always a realtor's market, guys. You can make plenty of money in a buyer's market. You can make plenty of money in a seller's market. You might have to change a little bit on what you're targeting for your activity. But the one thing that will never change is the agents that control the inventory always do well in either market. So the key to that is go for listings. Okay. Because if you have 12 listings, okay, 3 might go under contract this weekend. If you have 3 buyers you're working with, well, I don't know if you could work with all of them over the weekend. Maybe you can, but you got 3 chances. But if you have a buyer, you've got 13 chances to sell the other property, because there's 12 other agents that are going to be showing it as well. So I'd rather have 12 listings than 12 buyers. I'll tell you that, because buyers, no matter what they sign with you, they become a little bit impatient if you're not out showing them houses every single day. And they drive by something at night and they call you on the phone. Oh, we're all excited, and you look it up and you say, that's like 200 grand more than you can afford. Well, we're just wishful thinking. Yeah, right. That's okay. We need buyers and we need agents that love buyers, and we need sellers and we need agents that love sellers, because without the sellers, we don't have any inventory to sell. Okay. Thanks for being with us tonight. I do have a phone number. It's 801-556-8000. That's my cell. You're welcome to call. Do not call me during the exam itself. And anyway, appreciate you being here tonight. if we can help in any way, call us at the school, or you can use my cell number if you want. See you later. Thank you very much for being here. And thanks, Dan, for running the back end. See you later. Bye-bye.
Thanks for watching. If you want to show some appreciation to our instructors, be sure to like and subscribe so that they see how much you enjoyed it. And if you want any additional review material, check the links below for our full suite of practice materials for the real estate license exam. Thank you.